Hey everybody, and welcome back to the Teaching Tax Flow Podcast, episode 122. Today we are kicking off our ACE series. So it's a three-part series, and part one today, we are diving into Schedule A. But before we do that, as always, let's take a brief moment and thank our episode sponsor.
Hi, Chris Picciurro here, founder of Teaching Tax Flow, co-host of the Teaching Tax Flow podcast, and pickleball enthusiast. Yes, if you listen to the podcast, you know almost every episode we talk about pickleball, the most popular and growing sport in America. We have tons of opportunities for paddles and pickleballs, but we don't have a lot of great gear on the market. Well, I'm so excited to announce that Sunsets and Dinks are now a sponsor of the Teaching Tax Flow podcast and produce amazing gear, not only to look at, but you feel confident on the court. Because you are part of the Teaching Tax Flow community, you get a 15% discount on all your orders with them. I know I love the gear I received, and I have quite a good record while wearing it. Believe it or not, even at my level. Go to teachingtaxflow.com/pickleball and simply enter TTF15 in the serve up promo code area of your paddle rack.
Hey everyone, welcome back. And as you heard in the intro here, we are kicking off our ACE series. So ACE, if you're, I don't even know if they're outside of Michigan, this area, but ACE, ACE is the place. It's the hardware store. So if you're familiar with that, you get my little joke there. If not, I apologize. Skip over it. You don't want to rewind it because it was corny, but we'll deal with it. So as we dive into here on part one of three, again, as mentioned in the intro, we are looking at Schedule A. So what is a Schedule A? We're going to get into specifically Chris here, my counterpart. I should say he has a much better hairdo than I do.
Oh, my word.
If you're watching this, you know what I'm talking about. If you're not watching this on YouTube and you're only listening to it, you need to get on there. You need to watch it. So go subscribe, check out the podcast. This is 122 episodes in. That means for 22 of them now, we've been doing video. So again, if you are an avid podcast listener, you now have the video option. So as we get into Schedule A here, Chris, I look forward to running through this because I know there's a lot of these. A lot of our audience uses them. So yeah, let's dive through this. If you don't have one of them in front of you, if you are listening, just Google it. Schedule A, Form 1040 IRS. You'll get a copy of it, and you can look at this while we're going through it as well.
Yeah, I mean, so I'm really excited about this ACE series. Schedule A, Schedule C, Schedule E, by far the most popular schedules within the Teaching Tax Flow community. I would say, if you look at these schedules, more than 50% of people in the Teaching Tax Flow community file at least one of these schedules. So remember, like you said, John, these are not separate forms, or rather, they're not separate tax filings on their own. They're part of someone's personal tax return or a 1040. However, they are very, very important attachments. So let's talk about itemized deductions. Before we jump into itemized deductions, let's remember something. Every taxpayer, all right, based on their filing status, gets a standard deduction. Now, for 2024, that amounts about $28,000 married joint, about $21,000 head of household, and about $14,000 for married filing separately or single. So you get that deduction no matter what. But for many, many taxpayers, they have a bunch of personal expenses that if you add them up, it's more than that amount, and you get to take those itemized deductions. And then on some states, you can itemize as well. But we're going to focus on the federal side of things. So let's talk through our most common itemized deductions. Like I said, John, Schedule A. We'll put a link to this form in the podcast. Oh, by the way, if you haven't watched us on YouTube yet, first of all, if you're tuning in for the first time, we're sorry. We're sorry. We're sorry. John and I are better looking. We probably sound a lot better than we look, and you're probably grossly disappointed right now. But that should not preclude you from still subscribing and liking this YouTube channel.
There you go. And Chris, I just realized something. I think for every one of these episodes we've ever done, including the ones that weren't on video, I think I've actually worn a hat for. Speaking of hairdos. Maybe one day I'll convince you to wear a hat and I'll actually do my hair. Maybe we'll flip
John,
it
I'm
up
waiting for that Teaching Tax Flow hat, or maybe my Michigan State Spartans, my Detroit Tigers, or my Tennessee Titans actually win some type of championship, and I will then don one of those hats.
Or I can just wear a Detroit Lions one or a Michigan Wolverines one, and then you won't record it with me. So one of the two. So
Well, I'm not worried about either of them winning a championship in the near future. So let's move on to Schedule A, itemized deductions. The most very common itemized deduction are going to be your medical and dental expenses. So medical and dental expenses, what you do is you add those out-of-pocket expenses up in the amount that exceeds 7.5% of your adjusted gross income. You'll hear that term called AGI quite a bit. The amount that exceeds 7.5% of your adjusted gross income is deductible. So for instance, if your quote AGI is $100,000 and you have $10,000 of medical expenses, well, 7.5% of 100,000, 7,500, you would be able to take that $10,000 of expenses, deduct minus $7,500, you'd get a deduction for $2,500 of medical and dental expenses. So that's going to be a very common itemized deductions. I do want to say another thing, John, as you well know. I know this sounds like we're plugging in the Teaching Tax Flow YouTube channel, et cetera, et cetera. We have a ton of content on that channel on all of these things we're going to talk about today, be it a 1-minute quick tip or a whole separate. I mean, we've got a whole separate podcast just on medical expenses.
Mhm. Mhm.
So,
Which was a good show, by the way. I enjoyed doing that one, and I know that's one of the ones that I personally walked away and like, wow, like did not know that. So and if I remember right, Chris, too, actually on that 1040, or on the Schedule A, it actually says right next to it, that 7.5%, right? So it's not like
absolutely.
you have to guess at it and remember this specifically.
And my advice is if you're using software, just put your medical expenses in the software and let it, you never know. Sometimes it could be close. So the next deduction are taxes that you've paid, the state and local. You hear this all the time, John. I know you don't come from a tax background, but SALT tax, right? What in the heck is SALT? State and local tax. Okay. And with the Tax Cuts and Jobs Act, that SALT tax reduction was limited to $10,000. Previously, it was unlimited. I mean, you would have, if you had $50,000 of state and local income tax, you would actually get to deduct all of that. Now, Tax Cuts and Jobs Act is in the process of potentially phasing out. We have a ton of content on when we had the presidential election of 2024 and what the candidates are running on. But as of the time of this recording, $10,000 for a married joint, $5,000 if you're married separate, is the SALT tax limit. So what is SALT? And then head of households, $10,000. Singles, $10,000. Well, SALT means a couple things. One, property taxes. Two, any type of state and local income tax. So, John, you have the pleasure of living in the great state of Michigan, the winter wonderland state. I'm trying to think of all of the
Great Lake
the driver's
State,
license, the Great Lakes. I love
yeah,
though the Great Lakes state. I mean, that's just probably my favorite way to describe Michigan. And so you have a state income tax. Well, I'm here in the volunteer state, and some call it God's country, but we won't go down. That's a different podcast. And there's no state income tax. But so any state income tax you pay, any personal property taxes you pay that are ad valorem. What that means is that if the tabs you pay for your vehicle or RV or any of your toys that you have are based on the value of it, then that's deductible. Like I said, property taxes is another very common um, uh, state and local tax that you would pay. And then some people work in the city that there's a city tax. So you add those up and that's part of your itemized deductions. Now, if you own a business and you pay a significant amount of state and local tax because your business is very profitable, definitely reach out in the Teaching Tax or in our Defeating Taxes private Facebook group. You're going to want to educate yourself about PTET, which is separate from this, but I'd be remiss if I didn't mention it. I'd probably have my friends that are tax professionals that listen to this call me, text me, and holler at me for not mentioning the PTET potentially, which is a pass-through entity tax election. So that's part 2 of Schedule A, taxes that you paid. Part 3, interest that you pay. Now, for interest, remember, tax laws are in to encourage and discourage certain behavior. So the mortgage interest that you pay for a qualified home loan is deductible. That's a huge expense. When we talk about the benefits of home ownership, one of the main benefits is my mortgage interest is deductible. If I paid rent to someone, I wouldn't be able to deduct that as an itemized deductions. Now, with the Tax Cuts and Jobs Act, there are some limits to qualified home loan deduction. So for any mortgages taken out after December 15th of 2017, only the mortgage interest that applies to loans up to $750,000 is deductible. And if it was before December 15th, 2017, it's up to $1 million. So let's say, John, you end up building the Casa de Tripolsky, right? It's $2 million property, and you take a mortgage for $1.5 million. In that case, 50% of your mortgage interest would be deductible on the federal return because that's up to $750,000 of mortgage. And you track that. So, your tax professional is going to track that for you. We have several people in our private CPA practice that exceed that limit. I will say, if you have rental properties, hold on, you're going to want to tune into to the third part of this, which is Schedule E. Mortgage interest deduction for rental properties is completely different than your primary residence, or potentially even a second home. It could be a cottage or could be a boat with a bathroom. There's a lot of different qualified second dwellings. And then home equity loan interest is deductible if it's used for home improvements. Very transparent, John. We built a garage, and if you listen to this, we built a garage apartment. It has my office here. It has a second bedroom that is the John Tripolsky suite. For when you visit Franklin, we've got a kitchenette. Anyway, for some of this build out, we used a home equity line of credit. It was just easy, and that's deductible because I used it for home improvement. Okay, so points that you pay in your mortgage are deductible in the year that they're paid for primary residences. And then investment interest is deductible up to the amount of investment income. So, John, let's say you have an investment that's producing income, but you did use a loan to purchase that. So, and you're paying interest on that loan, you could deduct that. That's very common when you have, let's say, business ownership transition. So, John, let's say you're selling me your business and you're doing owner financing. And it was a stock sale, I would have interest on that stock. So,
Yeah. And it is interesting to see how all of it kind of, mind mapping this, if we will, how they tie together, right? So maybe, and I'm just making an assumption or a simple observation from the outside looking in is, the IRS, when they were creating this form, they probably looked at it as, okay, we'll allow a deduction. We'll take a HELOC, home equity line. We'll allow that deduction because it's going to be made up in other places. You know what I mean? Like your taxes are going to go up or something. It's just your value of a home, just kind of thinking and, looking at this form and seeing how everything's interconnected. I can only imagine how that planning process went, right? When they're like, hey, we need to create this form. What should we allow?
Yeah. I mean, it comes down to Congress. Congress they're the lawmakers, and they have remember we did an episode with LaShawn and from the Michigan Association of CPAs called "How Taxes Are Made," and we talk about the whole process of how something becomes tax law. Right? There's different committees. There's a Senate Finance Committee. And on the federal level, there's a House Ways and Means Committee, and they are kind of underwriting any of these tax bills. So I will point out on interest also. If any of the investment interest, you're going to have to file a Form 4952 form, and that gets attached to Schedule A. And it is very common, John, so when you have a mortgage, typically the mortgage company is going to issue you a 1098. That's the form that gets you the mortgage interest. But let's say that you bought something on a seller financing, and that wasn't reported on a Form 1098. That's okay. You could still deduct it. We're just going to need the name and social security number of the person you paid the mortgage to, and address, and we're going to be able to put that on Schedule A as well.
Excellent. So it's very similar to filing a 1099 or submitting a 1099.
Yeah, exactly. It's a de facto 1099.
Perfect.
Absolutely.
Okay. That makes total sense.
So the next big section, our fourth big section on Schedule A, is going to be gifts to charity, and gifts to charity are broken into two different categories, right? One are going to be cash or check. That's really straightforward. One of them is going to be non-cash donations. That could be gifts of clothing and vehicles and whatever you have, any type of property that's not cash that you donate, you could still deduct it for the fair market value. Now, there are special rules when it comes to gifts to charity, especially for non-cash donations. what you need to know is that non-cash donation. Let's start with cash donations. Cash donations are deductible for up to 60% of your adjusted gross income, as long as they're going to qualified organizations. So when we get a lot of questions in teaching tax law community like, hey, I gifted my cousin who was kind of down on his luck, and I gave him $1,000. Do I get a deduction for it? Unfortunately, that's considered a gift and it's not deductible. You know what? You probably got on Santa's good list for giving your cousin some money. Good for you. So cash contributions. Non-cash contributions, you get a deduction, like I said, for up to the fair market value of the contribution. And if your donations are over $250, you do need written acknowledgement from the charity. That is required. And if your non-cash donation exceeds $500, you have to file a Form 8283. And then special rules apply to property worth more than $5,000, where you're typically going to need an appraisal. So, John, just real life, it's like kids like to say IRL, right? One of my goals for the new year was like, I've got to clean my closet out. I have a bunch of old clothes. It's sad, John. I like a memory would come up on Facebook from 8 years ago, and I'm like, I still have the same jeans and same ratty shirt. I'm not buying anything else until I get rid of. And now half my closet, I've got every color teaching tax flow shirt, so now I've got to make room for it. And that hat that we're gonna get me. But so I took about, we got a little snow here in Franklin, Tennessee, where I'm at, which is very rare. We got like 4 inches of snow, and I'm like, we're all trapped here. I'm gonna actually go through my closet, and I I had 7 huge bags of clothing that I donated to a nonprofit organization. And I really looked at it and I'm like, I've got over $500 worth of stuff. So I actually went, got a receipt, documented it. And so it's kind of neat when some of these rules apply to your life. So
Yeah. So even like, we talk about gifting. So what, like maybe walk us through a real example, right? Like say you have a vehicle that's worth $25,000 or $35,000. It's from a family member, aunt, uncle, mom, dad, anybody. So walk us through that a little bit, how that would work. So I know you mentioned at certain points there's a threshold, then there's an appraisal. So how does it work A to Z?
yeah, vehicle deductions are very unique and they have special rules. So it might go beyond. There's a lot of we could maybe do a whole podcast just on donating vehicles. But here's what you need to know. The first thing is, if you have a vehicle worth $30,000, you're probably better off just selling it. Because even if you get a $30,000 deduction at a 25% tax rate, it's gonna pocket you $7,500 of tax benefit. So I'm just saying, a lot of times now, there are some times where let's say you had a vehicle and there was a church or something that you really wanted that needed transportation, and they wanted that vehicle and you donate it to them. What would happen, basically, you get a deduction for the fair market value of the vehicle the day you donated it. There's some serious substantiation requirements from a third party, or if you donate it to a charity, you're going to hear these, hey, donate your vehicle online. Well, guess what? Whatever they end up selling that vehicle for is what you get the deduction for. And there's some special rules as far as 8283 form and some 1098C. So good question. Just kind of goes beyond the scope of what we're talking about here. Definitely jump into taxes for that because we've got special content on that.
And I appreciate you even getting into it a little bit there. And yeah, that makes total sense. Cause yeah, you see a lot of those. I think one of them's in Michigan here. It's like Mrs. Waddles, donate a boat, vehicle, basically anything, drives or not. They kind of take it. So that's how that works, which is great.
And there are times where we've had situations where someone's their donation amount is actually more than the 50 or 60% of their income. If that's the case, then the amount that exceeds the income threshold actually just carries forward to the next year. So it's not like it's gone forever.
Gotcha.
But yeah. Casualty and theft losses. Now, with the Tax Cuts and Jobs Act, this changed quite a bit. If you have a casualty or theft loss, it's only deductible if it's related to a federally declared disaster area. So think about, John, if your house burns down, unless it's that's unfortunate, but a lot of those losses are not deductible anymore. But if you are in, California where there are wildfires and your house burnt down and it's a federally declared disaster area, now you could potentially take a casualty and theft loss. Or we think about our, the tragedy that has occurred in Maui over the last winter. Where do I figure out if it's federally declared disaster area? Check out the IRS website, irs.gov. They have a list of all of the disaster areas by state. Again, not to beat a dead horse, but jump into defeatingtaxes.com. We have a lot of these resources for you. But if you have a casualty or theft loss in a federally declared disaster area, that is deductible on your Schedule A. There's a formula. You've got to deduct $100 per event. So in other words, if you're in a disaster area and you lose a $50 baseball card, you're not going to be able to deduct that. There's a de minimis rule of $100, and it's got to exceed 10% of your income. So let's say, John, you have an adjusted gross income of $50,000 and you have an uninsured $10,000 loss in a disaster, federally declared disaster area. We'd take the $10,000, we'd minus $100, right? That's $9,900. We'd take your income, $50,000 times that by 10%. I know mental math is $5,000. So your deduction would be $9,900 minus $5,000. You get a $4,900 deduction.
Excellent. And even in Defeating Taxes, that Facebook group, I don't think that we've seen any chat around the fires out west, but I know for a fact that we have had multiple discussions started from Florida residents. And I think like Alabama, Mississippi with the hurricanes and the flooding that came in, because obviously the IRS stepped in, I think deferred some due dates for returns, et cetera, for that. But like, I know there was a ton of chatter on that. So it was good to see that some people are aware of it. But honestly, I would bet you that 8 out of 10 people don't know that you could actually declare those losses or claim those losses.
Yeah, definitely talk to your tax professional. Now, with the Tax Cuts and Jobs Act, unreimbursed employee business expenses, or what we would call in the business Form 2106 expenses, went away. So there aren't a ton of other itemized deductions anymore. I'm going to touch on the most popular one. Now, on some state returns, you could still take that on unreimbursed employee expenses, but one of the most popular one are gambling losses. We're going to finish with gambling losses. Gambling losses are deductible on in your federal tax return. 1, if you itemize, and 2, up to the extent of your gambling wins. All right, so John, we know you secretly go to the horse track every Tuesday night with your friends, right?
I like to bet on snail races. That's my thing, right? So dachshund racing.
If you lost, you don't get to, you can deduct it if you have gambling wins and if you itemize your deduction. So gambling losses, as far as the other itemized deduction, is going to be your most popular other itemized deduction. There are some other ones that are kind of needle in the haystack things, but that's going to be the one that's most common.
Well, hey, if my snail loses in my gambling adventures, at least I can turn him into what was it called? Escargot, is eating snails. He can be converted.
Right. Well,
that's
John,
what it's called.
I've got the palate of an 11-year-old, so I'm probably not going into the escargot. So
yeah, that is true. I don't think I've ever even seen you eat a piece of lettuce in the.
I like Caesar salad.
Oh, I didn't know that. Okay.
Oh, yeah.
All right. I learned something new.
But give me some croutons. There's got to be some croutons on it.
Cover it up. But awesome, everybody. Well, Chris, thanks for running through that form with us. Again, we'll put the links in the show notes so you could really follow along. We purposely followed an order in this discussion that kind of mimicked the form itself a little bit. So if you haven't yet, you want to go back and listen to this, print that form out, pop it up on another screen, listen to it, and kind of flow through it as well. I think you'll take a lot from this. But as we wrap up here, our first part 1 of 3 of the ACE series, obviously the next one we're going to look at Schedule C. So we look forward to seeing everybody back here on the Teaching Tax Flow podcast next week. Different time, same day of the week, but a different topic. We'll see everybody very soon. Have a great week.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.